Good day, welcome to the Tabaldi Accounting Intelligence lecture on IAS 12 Deferred Tax Basic Concepts. First of all, let's understand that IAS 12 is the international accounting standard under IFRS for accounting for income taxes in their entirety. Today we're going to focus purely on one aspect thereof, namely deferred tax. Now, it is very important to note that the principle behind deferred tax is the matching of the relevant tax charge to the relevant period as well as the relevant income. IAS 12 designates that we should use the financial position approach. Under both US GAAP and under international accounting standards, we use something called the comprehensive basis and not the partial basis, as what used to be used in many areas in Europe and Asia. Now, I'm going to spend a bit of time talking about the accrual basis in terms of the framework of international accounting standards and the fact that expenses should be recognized in the period in which they are incurred and matched back to the related incomes. So, tax expense in its entirety should be recognized in the period in which it is incurred, not necessarily when the tax is paid. Now here, we must understand that tax legislation in different countries throughout the world will often result in different timing of recognition for tax income as compared to accounting income. Deferred tax is our measure to try and match the full accounting tax expense to the operating profits and profit before tax. So before we go on, let's understand that our accounting is based on assets and liabilities. Assets, in terms of the framework definition, are future economic benefits. Liabilities are future outflows of resources embodying economic benefits. So therefore, when I recognize an asset or liability, I need to ask myself, what about the tax effects of those future benefits and future outflows? Now, for assets, the core thing to remember here is what does the carrying amount of an asset, let's say we are talking about property, plant and equipment in terms of IAS 16, that carrying amount represents future economic benefits. Now, for an item such as property, plant and equipment, those future economic benefits probably are operating profits. I'm going to use the abbreviation for profits there, pi. So on reporting date, that carrying amount of the asset is no longer thought of as a snapshot of the past and the cost thereof, but it is thought of as the crystal ball to try and view and estimate what those future economic benefits are. This concept is important as those future economic benefits will in all likelihood have tax consequences. So at carrying amount, at reporting date, we should also recognize the consequences of those future tax outflows on the future operating profits. So the future outflows in the future, i.e. the tax expense or tax payments to the revenue authority, well, should that not also be recognized if we recognize the carrying amount of the PPE? And that carrying amount is going to be a deferred tax liability. Now, a similar thought process can be followed for liability side of the statement of financial position. Namely, at reporting date, I might have a carrying amount of a liability, let's say a provision for instance, that will result in future outflows to settle that liability or obligation. Now, depending on the tax treatment, let's assume we are using a provision that is only tax deductible once it is paid in the future. Well, at reporting date, I've gone debit, expense, credit, provision. I've got an obligation. That obligation will be settled with future outflows. Let's say that there will be a payment to settle in cash. And what's going to happen is that there will be also tax consequences in the future. And there will be a future economic benefit when I make that payment. Sounds a little bit counterintuitive, but what will that future economic benefit be? It will be a tax deduction in my current tax computation. So at reporting date, what are those future tax deductions? Well, those are going to be my deferred tax assets. Okay, so let's make sure we've got the basic concept of assets equal future economic benefits, and therefore there will be future tax expense thereon, deferred tax liability. When I have a liability on my books, such as a provision, and I have future outflows in order to settle that obligation, well, there will be future tax deductions attached thereto, and that will be a deferred tax asset. In order just to cover this a bit more conceptually, we need to have a look at a small illustration. So let's look at Company A. And Company A has profit before tax of 100,000 in 2011, as well as 100,000 Rand in 2010. Now, Company A purchased an asset. Let's assume an item of property, plant and equipment, a manufacturing machine. And they purchased it for 5,000 Rand on the first day of 2010. The useful life of this asset for accounting purposes is 2 years and a zero residual value. Therefore, the asset will be depreciated straight line over 2 years, 2,500 Rand per year. Let's do a quick journal for that. I'll go debit depreciation, profit and loss, credit, well, the asset, but I have a sub account for the asset called accumulated depreciation in the statement of financial position. Each year that will be 2,500. The tax authority, however, has said that in year one you will get 100% tax deduction. So the tax expense, for want of a better word, is the full 5,000 in year one. So let's continue with this little illustration. And the illustration now moves towards my current tax computation. Current tax computation starts with profit before tax, and in 2010 that figure was given as 100,000 Rand. Remember that profit before tax already incorporates the accounting depreciation. So to get from profit before tax, which is an accounting figure, down to taxable income, which is a tax figure, we need to reverse out any accounting expenses that are different to the tax expenses. So the first thing to consider is my depreciation. I will add back the depreciation of 2,500 that was already included as an expense in the 2010 profit before tax of 100,000. However, the tax allowance, tax expense for want of a better word, was 5,000 Rand. Therefore, I ended up decreasing my profit before tax from 100,000 Rand down to 97,500 Rand. And that difference, ladies and gentlemen, is what I call a movement in temporary difference. And that is, in this scenario, you will see later on that this taxable temporary difference movement will reverse out in the future, such as 2011, where depreciation once again is added back and the tax allowance is now zero. The full expense for accounting and tax over the life of this asset are exactly the same, both 5,000 Rand. But the periods in which they are expensed for accounting and tax are different. So the 2,500 Rand taxable temporary difference reverses out in the 2011 year and becomes we used to call it a reversing taxable temporary difference. Now it's a deductible temporary difference. Okay, and you'll see that that 2,500 increases my tax expense from, my profit figure from 100,000 for accounting purposes to 102,500 for tax purposes. Now, in a perfect world, we need to go back and remember that I'm trying to match the accounting expense to the correct period in which the accounting income is earned. So in 2010, as well as 2011, I have profit before tax of 100,000. So hypothetically, at a tax rate of, let's assume 28%, I would have a tax expense of 28,000. But because of these timing differences or temporary differences between accounting and tax profit and loss, I'm landing up with a tax expense in 2010 of 27,300 and in 2011 of 28,700. Take note the tax expense overall, has not changed. It's just the periods in which it differs. So if I take my 27,300, compare it to what my tax expense hypothetically should be at 28,000, tax expense is understated, for want of a better word, by 700 Rand. Remembering that the 27,300 is the tax that I will actually have to pay over to the tax authority in 2010. But the tax for accounting, ignoring any permanent type differences, that should have been 28,000. So I need to go and increase tax expense by 700, and I'll have some type of liability of 700. And what you'll see is in the next year, my tax expense suddenly is 28,700 that I have to pay over to the receiver, and the accounting tax should have been 28,000. So in this scenario, I need to decrease the tax expense by 700. And how do I decrease an expense? I'm going to debit the liability and I will credit tax expense to make it smaller. Now, we haven't got into what we're calling that tax expense yet. We know that the original 27,300, for instance, is going to be your current tax expense, and you'll credit your current tax liability with 27,300. I think you've guessed by now that the 700 Rand increase or decrease, that is going to be a deferred tax expense movement. Now, IAS 12 is quite clear that we should be looking at this from the financial position approach, whereas the current tax computation is looking at this more from your profit and loss side. So let's go and have a look at the statement of financial position approach. Here, there's a very well-known and accepted methodology. First of all, you will split up your calculation into 4 columns. First column, carrying amount. Carrying amount, of PPE, as we discussed earlier, that is representative of the future economic benefits, which equals the future profits. Then, my tax base. I'll deal with definitions of tax base in a separate lecture, but take it for now that the tax base of an asset is equal to the future tax deductions. My wear and tear or capital allowances. So in this scenario, let's have a look on day one. On day one of my property, plant and equipment life, I purchased the asset and I purchased it for 5,000 units of currency, whether it be rands, dollars, euros, whatever. That 5,000 Rand represents, at a conservative estimate, 5,000 Rands worth of future economic benefits. We wouldn't have paid 5,000 Rand if we didn't expect to at least get 5,000 Rand out in the future. The tax base at this stage, we have not claimed any allowances yet, so that 5,000 Rand future tax deductions are still fully intact as a 5,000 Rand deduction still to be claimed. Temporary difference on day one, 0, times it by 28%, deferred tax. Well, that gives me 0. Now, ignoring the movement column, let's go and have a look next at the balance of the PPE at reporting date 2010. At reporting date 2010, I have depreciated this 5,000 Rand asset by 2,500 Rand. Therefore, I have got 2,500 Rand left of future economic benefits. The tax base, however, well, we got 100% capital allowance in the first year. Therefore, I've got no future tax deductions remaining. The difference, carrying amount minus tax base, well, that leaves me with a temporary difference of 2,500 Rand. That 2,500 Rand, if I want to look at this conceptually, future economic benefits, carrying amount of 2,500, is greater than 0 future tax deductions. Therefore, 2,500 Rand represents future taxable income. And that is what we call a taxable temporary difference. Okay, that temporary difference of 2,500 when times by 28% will give me the future tax consequences of that future taxable income, i.e. a 700 Rand future tax obligation. We expect to pay 700 Rand tax in the future. Extra. Therefore, it's a liability. So the movement thereof is what I'm after. I need to go PPE balance on day one to PPE balance at the end of 2010. And likely, I need to do deferred tax balance of 0 on the first day to a deferred tax balance of 700 Rand at the end of the period. The movement is what I'm worried about. So to journalize that movement, I will go debit deferred tax, profit and loss, and I've increased from a 0 to a 700 Rand liability. Liabilities get bigger on the credit side. Credit deferred tax financial position, both of them 700 Rand. Great, similar process for the next year. In the next year, 2011, my PPE has moved to a 0 carrying amount, fully depreciated. Tax base is still sitting at 0, temporary difference 0, and I should have no deferred tax balance. Please hear me, deferred tax balance is 0. So in this scenario now, I've gone from a 700 Rand deferred tax liability to a 0 deferred tax balance. Therefore, the movement for 2011, well, let's think. I had a liability balance, which is a credit balance. I need to make the balance sheet side back to 0. So I'm going to go debit deferred tax financial position, credit deferred tax, expense profit and loss, 700. Okay, and those are your journals you'll pass. Just to make sure that we've got our proof correct, let's go back to our current tax computation, and you'll see the journals at the bottom that we were doing a couple of minutes ago. Well, we call the tax expense. Now we're just going to erase that. And I'm going to call it deferred tax expense profit and loss, same amount. And the same on the other side. The credit is going to a deferred tax profit and loss expense, 700. The check that I always use is taking my movements in temporary difference in my current tax comp. I look at that negative 2,500. I know negative here means that I've decreased taxable income this year. Therefore, when it reverses in the future years, it will increase taxable income and therefore increase tax expense. Therefore, it's a taxable temporary difference. Well, I go back and I look at the movement in my temporary differences. I went from 0 to a taxable temporary difference balance of 2,500. My taxable temporary difference movement is therefore perfectly in line with my current tax computation. Perfect. Moving on from the calculations now. We've done these journals. The first year, I've raised a current tax expense of 27,300 and a current tax liability of 27,300. The deferred tax expense side, I've just shown you that journal, year 2010, we increased the expense by 700 and created a liability through a liability movement of 700. Debit the expense, credit the liability. In 2011, the current tax was based on the increased taxable income and the deferred tax expense. Well, here we reversed out that deferred tax liability, so I needed to debit the liability. I make a liability smaller by debiting it, and the other side goes to deferred tax expense, profit and loss, a credit, an income. To finish off, let's have a look at what the disclosure in the notes to the financial statements, very simplified, would look like. The first note that you always need to do is your income tax expense. And the income tax expense note is made up of two items: the major components of tax expense, as well as your tax rate reconciliation. Because there's no reconciliation required for this illustration, I'm only going to do the major components. Major components split up between my current tax expense and my deferred tax expense. There could be multiple elements to each of these two components. Here, very simplified. The current tax expense, we can go back and look at Journal 1 for each of the 2010 and 2011 years. There's my debit current tax expense 27,300, debit current tax expense 28,700. The trick comes in with the deferred tax expense. Here, I often can have a credit tax expense or a debit tax expense. In 2010, I went debit deferred tax profit and loss, credit deferred tax financial position, and created a deferred tax liability. In 2011, it's the other way around. I reversed out that deferred tax liability and I credited deferred tax profit and loss, making the deferred tax expense smaller. I add them up together, and please note that I land up with my perfect 28,000 Rand tax expense. Now, this is a very simplified example. There's no capital gains tax effects here. There is no reconciling items, no change in tax rates, no unrecognized tax loss. Again, this is to illustrate the basic principles and how these things fit together. Please don't forget, the rest of your income tax needs to also include this concept of other comprehensive income. This illustration did not cover other comprehensive income. Tax rate reconciliation separates the men from the boys. There is always something complex in a real life situation that results in your deferred tax, or your total tax expense, apologies, okay, meaning that your effective tax rate is not necessarily equal to the statutory tax rate. That could be items such as capital gains, non-taxable income, non-deductible expenses, etc. And what everyone also forgets to teach is that there's also a deferred tax financial position note, where we need to list all the items that are on your deferred tax balance calculation. Here we also should be splitting up between the different tax rates being used, but again, for a future lecture. Great, thanks very much for your time. I hope you found this useful, and yeah, keep tuning in. We will be giving you some more advice in the future. Thank you.